Hey everyone, Couch Investor back to another Tesla weekly video for today. Hope you're all having a wonderful weekend so far. First of all, I want to thank you all for all the nice messages I've been receiving this week on X and on YouTube. I really appreciate that. My family really appreciates that. So from the bottom of my heart, thank you very, very much. Now, let's talk about Tesla because, well, I've been gone for a couple of days and a lot of things have happened. As you can see here on the screen, we are now at $183, market cap of under $600 billion. Now, what happened? Well, earnings report. Now, earnings, it did miss a little bit, but that wasn't really the issue. The issue was the messaging. No real outlook, no guidance for 2024, at least no guidance that Wall Street likes to get, right? Because Wall Street usually at the start of a year, actually every quarter, but especially at the start of the year, wants to have some guidance for the year, and so they can start making their own models, making their own assumptions, etc., etc. With Tesla, first of all, usually we barely get any Wall Street numbers, right? We get the guidance for the vehicles, but for the rest, not that much. And now for this year, even for the vehicles, we didn't really get much. So Wall Street wasn't really happy with that. The earnings score was, in my opinion, even worse than normal. Usually I'm like, okay, you know what? It's Tesla, it's Elon, CFO. Okay, we're used to it. But this time I feel the earnings score really didn't address a lot of core issues. Again, Wall Street cares about that and it punished the stock. Rightfully so, in my opinion. Now, currently, if we look at PE in the next 12 months, EV to EBITDA, price to sales, price to free cash flow, that's in the last 12 months, we can see that all of them, besides the price to free cash flow, but that's in the last 12-month metric, all of them are cheaper compared to the 3-year mean. Now, that doesn't mean that right now it's a no-brainer. Of course, for some people, it's still a no-brainer. Every day they buy Tesla stock. But from a pure Wall Street perspective, yes, it is lower right now, but before it got a higher premium because of the growth rates, right? Because of the high margins that it had compared to its competitors. Right now, is that still the case? No, especially not for 2024, right? Already in 2023, we saw margins go down because of price cuts, high interest rates, so you cut pricing, increase volume. Okay, logical thing to do. We've seen that other car makers have done the same. Apple is doing the same now with its iPhone as well. Not the first time, by the way. But for 2024, not much growth. We don't know what happens with future price cuts. We don't know what will happen with margins. And so right now, even though compared to its 3-year mean, the stock could be more expensive than before, despite it being lower than the 3-year mean. Something to take into consideration. Now, looking at the current price target, the average price target for the analysts, there are 44 analysts covering Tesla. 22 of those, so basically 50%, have a hold rating. The average price target still sits at $220, representing 20% upside. As you can see, before the earnings report, the price target sat at $235. Afterwards, it dropped and maybe it might drop even more, but still 20% upside. As for what the analysts are expecting for fiscal year 24, 25, and 26, you can clearly see that most of the market, even retail investors, know that 2024, fiscal year 2024, is going to be a year of not much growth, right? Sales growth, 14%. Some say it's going to be closer to 10%. With regards to EPS, barely a 4.3% growth year over year. But the story reignites itself in fiscal year 2025 and onwards with the launch of the supposed Model 2, which they said should be ready or should start production already second half of 2025. So although it sounds like a long, long time, I mean, the Cybertruck was announced a couple of years ago and now it's actually here. We've got Model Y, Model 3 refresh, maybe a Model Y refresh as well. Yes, it does sound like a long time, but time passes quite quickly. And so, fiscal year 2025, sales growth of close to 25% year over year, EPS growth of close to 40% year over year. Going into fiscal 2026, sales growth of another 15.3%. And then with regards to EPS, another 20%, reaching $5.46, which means you're paying around 33 times fiscal year 2026 earnings. Now, before I continue, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, moving on to the China weekly insured numbers before jumping back into the earnings report. So the weekly insured number for the week of January 15 to 21, they reported 11,700 insurance registrations. So the momentum here continues. That's great. The quarter is up 34.3% quarter over quarter, and it's the highest third week of the quarter ever. As for the model mix, we have 2,882 Model 3 and 8,969 Model Y. So it's a bit higher than the 11,700, but as you can see, good momentum at the start of the year. Now, jumping into this earnings report, I'll start with the outlook because that's probably where most people's expectations got, let's say, crushed. Remember, at the start of the year, I made a video called Tesla Reset the expectations, right? Because we ended 2023, which I think way too high expectations for this year. So I made the video. Some people didn't agree, some people did agree, but I do think that right now, most people agree that we have to reset our expectations. Maybe now the bar has been set extremely low for them to exceed it later on. I would much rather have that. Under promise, over deliver. Much better moving forward. Now, with regards to outlook, volume, this is where we get usually the guidance for the year. Now, they say here that the company is currently between two major growth waves. The first one began with the global expansion of the Model 3 and Y platform. And the next one, we believe, will be initiated by the global expansion of the next generation vehicle platform. In 2024, our vehicle volume growth rate may be notably lower than the growth rate achieved in 2023, as our teams work on the launch of the next generation vehicle at Gigafactory Texas. In 2024, the growth rate of deployment and revenue in our energy storage business should outpace the automotive business. Should not really surprise a lot of us. We've seen that already happen in 2023. Growth rates for the energy business outpaced the growth rates of the automotive one, and even their margins are higher than the automotive one. Fully expected it to continue in 2024. Now, of course, it's still only a small chunk of Tesla's business, but if it continues to grow like that, every year it will become a bigger and bigger piece of the Tesla pie. Now, talking about that side of the business, of course, energy storage deployment, I mean, look at that beautiful graph. Beautiful. With regards to solar, as expected, we've talked about Solar Edge, we've talked about Enphase, was to be expected. Again, high interest rates environment, not great for that sort of business. When interest rates will come down, maybe it will get a push. It will probably take some time until that business is revived. But again, it is high interest rates environment, solar, car market, they get hit hard. Up next, I want to focus on this chart right here, cost of goods sold per vehicle. It is now slightly above 36,000, which has been coming down for a couple of quarters now. Now they say they're nearing the natural limit of cost downs on their electric vehicle lineup. Of course, with the next generation vehicle, things can change. Even with the new ones, right, the refreshed Model 3, maybe a refreshed Model Y, even Cybertruck, when those will ramp up more and more. These vehicles, in my opinion, should also cost less than what they used to. I mean, they do even talk here about, they even tell us the solution here already. Vehicle and software, right? We deliver the Cybertruck with an all-new user interface and new communication bus, Etherloop, that efficiently moves data while significantly reducing wiring, meaning reducing costs. Every little improvement made in a car, every part, every wire, every bolt that gets taken away from the car and still makes the car perfectly good one, reduces the cost to produce a car, will reduce the cost to buy that car as well. Now, quickly looking at the main numbers here, I want to touch on a couple of things. First of all, of course, the obvious total automotive revenue barely growing year over year. Energy generation and storage revenue growing just 10% year over year and a decrease here. Remember, this is about recognizing revenue. Sometimes they ship projects, they have contracts, etc., etc. They only recognize it whenever it is fully installed and operational. So sometimes you will have quarters where that number is up way more than before. Sometimes that number will be a bit lower, just so you know. Now, with regards to total revenue, only growing 3% year over year. Total gross profit was expected down 21%. Total GAAP gross margin down 612 basis points. Now, with regards to income from operation, that reached just over $2 billion, down 47% year over year, but an increase quarter over quarter. And so operating margin is also up quarter over quarter to 8.2%, but still down 784 basis points year over year. Free cash flow for the quarter, huge increase here quarter over quarter. Year over year, that's up 45%. Now, of course, it gave us an explanation with regards to the profitability side of things. They say here, while it did not impact operating income, we did record a one-time non-cash tax benefit of $5.9 billion in Q4 for the release of valuation allowance on certain deferred tax assets. Now, here you can see the hits that they've taken: reduced vehicle ASP, increased operation expenses, partially driven by AI and other R&D projects, lower FSD revenue recognition. This is still a segment of the business that will fluctuate for, in my opinion, the next couple of years. Now, the company, we already know, has enough cash to survive, has enough cash to invest in its future projects. And of course, with the stock price coming down, talks of announcing a share buyback program will probably come up yet again. It will also help with the fact that it might increase Elon Musk. It will increase Elon Musk's stake in that company and directly rewards shareholders as well. And so last thing for this video is the graph. I want to touch on, of course, this area right now after the earnings completely broke down. 200 did not hold at all. And so in my opinion, the next area we should be looking at is between $150, $160. Was previously a resistance, then we broke that in November of 2022. Here was a support at 160 at around April 2023. If that doesn't hold, then yes, look down below, closer to the $100 where we were at the start of 2023. With regards to RSI, it is getting very, very low. This is on the weekly. If we can get oversold in the next week or two, I do think it's going to be a buying opportunity. But saying that it is not fair for the price of the stock to go down right now, in my opinion, is not true. I think the hit here is justified. You cannot have such a high multiple on a stock, especially not right now, when the growth rates are just not there. You cannot justify that. Of course, who cares what happens in the next 12 months, right? Besides Wall Street, they care, they make the market. We invest for the next 5, 10, 20 years. So take those opportunities. If it goes down lower, why not enjoy a big buying opportunity? Of course, these are just my thoughts. Right now, I've not bought any extra shares. I'm waiting to see what happens in the coming days and weeks. Of course, do share your thoughts down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.